Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Q3 Market Update: Tech Giants, Smart Money, and Consumer Data. This video presents a direct informational narration of the source document.
So let's take a look at the agenda for this explainer. First up, we're going to cover the tech giants' latest moves. Then, we'll look at some warning signs popping up in the semiconductor market. Third, we'll explore why the smart money is pausing on AI. Fourth, we'll dive into some signals showing a slowdown in consumer spending. And finally, we'll wrap up with the key market levels you need to watch.
All right, Section 1. Tech giants' latest moves, specifically looking at some big updates from Broadcom and NVIDIA.
Now, what's literally incredible here is just the sheer scale of the capital we're talking about. Broadcom just signed an agreement with Apple that's valued at over $30 billion. $30 billion. This massive deal is all about chip development and supply. And as you'd probably expect from such highly favorable news, Broadcom stock got a really nice bump. It rose 4.83% on heavy trading volume right as it was testing some key technical levels.
Turning our attention to NVIDIA, their stock actually ticked up 3.65% based on some new headlines out of the Chinese market. It turns out some of China's biggest AI players, we're talking Alibaba, ByteDance, and DeepSeek, are planning to buy NVIDIA's advanced H200 chips. But here's the catch. These purchases are strictly limited to pretty small quantities, so this might be more of a symbolic win rather than a massive volume driver. But, the absolutely crucial takeaway here for us is this. NVIDIA's current performance and forward guidance already completely excludes sales to China. Because of that, any revenue they pull in from these limited sales, it's basically just a bonus. Their baseline valuation is entirely insulated from that specific geographic risk. Moving right along to Section 2, Semiconductor Market Warning Signs. We're going to focus on the international metrics and institutional caution here. And keeping the bigger picture in mind, all this data is playing out against a backdrop of global geopolitical tensions.
To really grasp what these international indicators are telling us, we first need to get our definitions straight. A technical bear market is defined as a price drop of 20% or more from recent high points. This isn't just your standard 10% market correction, it's a much bigger deal. If we look at the South Korean Kospi Index, which, by the way, is a massive barometer for the global semiconductor industry, it just suffered a really severe downturn. It dropped 22% from its peak, officially dragging it right into technical bear market territory, and that was punctuated by a pretty sharp 5.35% drop just the other day.
And this perfectly highlights a really dangerous divergence happening in the market right now. Global foreign funds are aggressively taking profits. They've sold off over $100 billion in South Korean equities so far this year. But at the exact same time, local South Korean retail investors are doing the exact opposite. They're pulling from savings, leveraging up on credit, and just pouring money into these declining markets. It's kind of like trying to catch a falling knife with borrowed money right while the massive global institutions are offloading.
This institutional caution is summed up perfectly by a portfolio manager at Fidelity International. They said, if this chip spending pattern proves unsustainable, then there will be downside risk. That right there hits the nail on the head. It exposes a massive dependency in the market today that you need to be aware of. Think about it. The soaring demand for AI semiconductors is currently being driven by roughly $1 trillion in capital expenditures. And that $1 trillion, it's coming from just a handful of massive tech companies. The entire sector's valuation basically hinges on the hope that these few giants are going to keep up this totally unprecedented level of spending.
So translating all that anxiety into technical levels, let's map out the path for the SOXX ETF. The golden rule here is that broken support becomes overhead resistance. For the SOX to just stabilize, step 1 is it absolutely has to halt its drop and hold above that crucial 582 support level. But holding support really just stops the bleeding. Step 2 is that for a true, valid upward trend reversal, the kind you'd actually want to see before taking new long positions, the ETF has to decisively break above the 621 resistance level.
Okay, on to Section 3, Smart Money Pauses AI. Here we're analyzing findings from the Global Family Office Report.
A recent UBS report surveyed 307 family offices. Now, these aren't your average investors. This represents highly conservative smart money with an average of $2.7 billion in assets each. And what they found is pretty staggering. 60% of these offices are planning to change their asset allocation over the next 12 months. That absolutely shatters the historical high, which was just 37%. These conservative funds are actively maneuvering to protect their capital, and they're explicitly preparing for a convergence of major geopolitical conflicts, mounting debt crises, and broader financial market risks.
When we look specifically at how this smart money views artificial intelligence, the data is super revealing. So a solid 65% of these family offices currently hold AI-related assets. But here's the kicker: only 7% plan to increase those investments over the next 12 months. Now, just to be crystal clear, they aren't panic selling what they already have, but they are absolutely refusing to chase these sky-high AI valuations at the top of the market. Instead, they're pivoting toward much more defensive infrastructure strategies.
Which brings us to Section 4, Consumer Spending Slowdown Signals. We'll be using Costco's recent monthly data to see what it tells us about the broader economy.
Shifting gears from high-tech to the everyday economy, let's use Costco as a sort of bellwether for consumer health. While Costco's absolute total sales did hit a record high, their same-store sales growth, which is the really critical metric, paints a totally different picture. Growth was strong in April at 11.6%, and it peaked in May at 12.5%. But then in June, that growth rate slowed way down to just 8.8%. That marks the lowest level of growth we've seen since February.
And honestly, when you break down the nuances of that June data, the slowdown becomes even more obvious. Gasoline price hikes actually artificially inflated the overall growth by 2.5%. So if you strip out the impacts of gas and foreign exchange, the core U.S. same-store growth was really only 7.6%. Canada was at 4.9%, and international was 5.6%. Why does this matter for us? Well, this slowing momentum is a huge deal when you consider Costco's incredibly high valuation multiples. We're talking a forward price-to-earnings ratio of 76 for August 2026 and 83 for August 2027. Consequently, we need to closely watch the key technical support level at 867. If it falls below that price, we could be looking at a sharp mean reversion right back to historical norms.
Finally, we have Section 5, Key Market Levels to Watch. Let's focus on the critical downside risks for some of the major ETFs.
Let's pull all of this together and map out the comprehensive risk across the broader market. We've got critical support lines for 3 heavily weighted ETFs to keep an eye on. For the XLK Technology ETF, the line in the sand is 172. Breaking that could trigger roughly a 15% downside drop. For the XLB Materials ETF, the critical zone is between 48.6 and 49.7. A break there opens the door for a 10% drop, targeting the 45.4 level. And lastly, for the XLY Consumer Discretionary ETF, vital support sits between 110 and 113. Losing that level implies a 10% downswing toward the 100 mark. Now, because these specific sectors carry so much weight, if they break these levels, it would heavily drag down the entire broader market.
So, if AI capital expenditure slows and consumer spending cools, what sector will drive the next phase of GDP growth?